Hi, this is Nitin Seshadri. Welcome to video number 2, which is part of an ongoing series of videos on financial literacy, what to do about the stock market, and how you do option trading, which is something that I promised that I would get to. Before I get into those videos, I want to spend this one video getting one subject out of the way, because this is a subject that a lot of people have talked to me about over the years and even very recently. Many people have told me, Nitin, what if we just forgot about the stock market and just parked our funds in gold or in silver or some of the or gold or silver equivalents, right? Would these not generate the same returns or equivalent returns as the stock market? Some people then furnished me some graphs on carefully selected time scales that purport to show that investments in gold and silver would actually have yielded more than the stock market investments. I'll tackle each and every one of those contentions separately in the course of this video. First, take a look at the top right corner of the screen and you'll see this interesting story. Indians have a large appetite for both gold and silver. This story shows that just one company, Muthoot Finance's gold stocks, are today higher than the gold reserves of entire nations. Then there is this story that's right up on the top that shows that the demand for physical silver articles, silver bars, coins in India has reached such a level that there is a physical shortage of silver in India right now. And because there is a physical shortage of silver, the prices of silver in India are trading at a substantive premium to the global price of silver. In other words, there is a silver bubble that we are operating in at this particular point in time. Let's take a look at some numbers though, because I can tell you one thing. If we are looking at an investment, let us first define what an investment is. An investment is something that you must be prepared to buy when the price is low, and you must be prepared to sell it when the price is high. If you have no intention of selling something when it is time appropriate for you to sell it, or if there's something in your psyche or your principles that militates against you selling it, then that thing that you've put money in is not an investment. Why am I saying this? Because in middle class families in India, there is this substantial feeling that one should not sell gold. There is this kind of thing that bechara wo sona bech liya, if you say it in Hindi, right? He sold his gold, poor fellow, he's been reduced to that level. So gold in many cases I do not even view as an investment, because if you're investing in something, you must be prepared to sell. And if you're not, then don't even get into it. Let's say that you've crossed that threshold and you're ready to invest, if not in physical gold, in a gold substitute or something that tracks the gold price. It could be a sovereign gold bond, or it could be a gold exchange traded fund, and so on, right? So let's do something. What I did was quite simple. I went to the BSE Sensex. Why did I go to the BSE Sensex? Because it's the oldest stock market index in India. It predates the NSE Nifty by many years, right? Data is available on the BSE Sensex starting from Jan of 1986. That graph is up here right now in the top right corner. If you have looked at this graph, you would have seen that the appreciation of what you put into the Sensex in Jan of 1986 is today 147 times. I'll repeat again, it's 147 times, right? And now I will place the equivalent numbers for gold. Gold was 2,140 rupees for 10 grams in January of 1986. It's today about 130,000. I won't quibble about the exact number. It doesn't make a difference to the point I'm making. The point is, in gold, the appreciation it's now worth 60 times what it was in 1986, which sounds great. But remember the other number that I told you, what the BSE Sensex is? 147. And that's not the end of the story. Versus 147 is not the real number. Why? Because one needs to look, in the case of stock market investments, as something called the total return index, or TRI. So what does TRI mean? Let's say I invested in the 30 scrips that constituted the BSE Sensex in 1986. Just hear me out. Let's assume for a minute, it's not been the case, but let's assume that these 30 scrips stayed constant for 39 years, and they're the same 30 in the Sensex today. Over the last 39 years, those various scripts would have paid out dividends to you. Okay. Now, what the total return index assumes is that you took those dividends as and when they came in and reinvested them back into the Sensex. Okay. Remember, gold generates no returns, zero, right? Physical gold generates nothing. Your gold ETF generates nothing. Your sovereign gold bond generates, I think, 2%. Okay, let's ignore the sovereign gold bond for the time being, because it has various other problems in of itself, and that would require a whole different video to talk only about the sovereign gold bond and why you shouldn't be in sovereign gold bonds, period. So if I look at this number, you will be shocked to know that the total return index in the case of the BSE Sensex is not 147 times. It is, and hold your breath, 650 times. I'll repeat again, 650 times. In other words, an investment of 1 lakh that's placed in the Sensex in 1986 January, had you just taken the dividends that came in with that 1 lakh of investment, kept on reinvesting only those dividends, today that will be worth 6.5 crores. The same money, if you looked at it, you took 1 lakh and put that same money in gold in 1986, it would be worth 60 lakhs. 60 lakhs versus 6.5 crores. Have I made my case? I think I have. If you're any sort of serious investor, you would not be investing the bulk of your money in precious metals, gold or silver, irrespective of how attractive it looks at the moment. There will be some quantum of your total investments that need to be in these avenues, mainly as a hedge against any sort of catastrophic event that suddenly crashes stock prices. But that kind of hedge would need to be a small percentage of your portfolio, not the overwhelming part of it. The overwhelming part of your portfolio, especially if you're young, if you're in your 30s, in your 40s, even if you're in your 50s, needs to be in equities. That's the only way to grow your money and to make your money work for you. Because when you stop working for your money, you'd better have your money all positioned, ready to work for you. I hope you liked this video. If you like this, do subscribe to my channel. Its details are below, and more videos will be coming telling you a little more about stock market investing. And after a few such videos, I'll get into option selling, what you can do, should not do, and all the rest of the things I promised in video 1. Nice talking finance to you, all of you, and have a wonderful and prosperous Deepavali and a year ahead. Thank you.